It's Christmas in July time, so I thought it would be an ideal time to give you an economic update on where we were 1 year ago, where we are now and where we are headed. This time last year, the Federal Reserve had only raised rate one time in this cycle. No other central bank had followed suit. The word deflation was still being whispered. Bond yields had not yet bottomed in the key global economies and in Australia. Trump was not yet in power, and the global economy was still looking a little fragile. Fast forward 1 year and the groundhog hasn't surfaced from its burrow, so the world does look very different, and with it the risks. The US Federal Reserve has now raised rates 4 times in this tightening cycle. The Federal Reserve's dots indicate that they will hike rates 1 more time this year and 3 times next year. Financial markets are pricing in a lot less than this, so there is considerable room for bond yields and currencies to react if the Federal Reserve is right. The Bank of Canada has raised rates, making it the first central bank in the major economies to raise rates after the Fed. And Sweden's Riksbank is widely expected to follow suit. Then there is the approaching end of quantitative easing in both the US and Europe. The US will start reducing its balance sheet this year, and the Eurozone will start to have a discussion later this year about when to start tapering its asset purchases. At home, the Reserve Bank of Australia's rhetoric has suggested that the next move in the cash rate might be up. While we think the RBA is still on hold this year and next year, market participants have clearly changed what they think the RBA will do over the next year or so. Cash rate futures are now attaching an 80% probability that the Reserve Bank will raise rates by the end of next year. The recent minutes from the RBA referred to a neutral policy rate. That's the first time ever Australia's central bank has actually pinpointed a rate for the neutral rate. It is that rate that is neither stimulating economic activity or dragging on economic activity. The RBA perhaps wants to send a message that the next move in rates is up, even though it may well be some time away. Whether the RBA hikes rates or not, Australian bond yields and swap yields are headed higher because they're being dragged higher by US bond and swap yields. The era of aggressive monetary policy easing around the world that has kept bond and swap yields low for so long is clearly over. Nothing lasts forever. Central banks around the world, including our own Reserve Bank, are being guided by economic and inflation developments. The D word, deflation, has been replaced with the R word, reflation. A rise in oil prices and commodity prices has contributed to a modest increase in global inflation, although from very low rates of inflation in recent years. Whilst that is the case, core inflation does remain subdued in the US and in other major economies. The US Federal Reserve hasn't given up on the Phillips curve. The Phillips curve is the idea that as the unemployment rate falls, wage pressures build up. The Federal Reserve indicates that low inflation at the moment is due to a number of temporary factors, and wage and inflation pressures will rise in the future. The US unemployment rate is arguably below its natural rate. Whilst we have this inflation backdrop, and inflation is a guiding principle for monetary policy, an argument can be made that leaving rates too low for too long can encourage risk-taking and risk to build up in financial markets. Turning to bond yields, it is still a case that underlying economic fundamentals in the US suggest that bond yields will move higher over the next 12 to 18 months. Australian bond yields, especially from 2-year maturities and out, are being highly influenced by US bond yields. The correlation is very high. So we can continue to expect Australian bond and swap yields from 2 years and out to be continued to be dragged higher by US bond yields. They won't be dragged up quite by as much because our domestic story is a different one to that of the US. Shrinking the Fed's balance sheet, which is in prospect, should add to further upward pressure on US bond yields and in turn Australian bond yields. That is because the Federal Reserve itself has said that quantitative easing contributed to a reduction in term premiums of 100 basis points. The change in US presidency late last year did not dampen economic activity. At first, bond yields rose on expectations that Trump's policies would boost growth and stoke inflationary pressures. Earlier this year, bond yields retraced some of their rise as financial markets realised that Trump wouldn't be able to deliver everything he has promised. If some of Trump's policies come to fruition, then there should be some continued upward pressure on bond yields. And the reality is that Trump will probably get some of his policies through. Trump is larger than life. He is creating uncertainty. The really interesting thing about this year is that most of the risk to the global economy is actually coming from political risks, not macroeconomic risks. For the first time in many years, the major economies around the world are witnessing a synchronised economic expansion. Global growth looks rosier than what it did a year ago and no longer as fragile. The International Monetary Fund expects the world economy to grow by 3.5% this year, 3.6% next year, up from 3.1% a year ago. We recently received GDP figures on China, and that showed that the Chinese economy grew by 6.9% in the second quarter, and it is now well on track to achieve the country's growth target this year of 6.5%. The Australian dollar remains a barometer of global growth, so the improvement in global economic activity is providing upward pressure on the currency at a time when the narrowing Australian-US interest rate spreads are providing downward pressure on the currency. Our forecast is for the Aussie dollar to finish this year at 78 US cents, which is a modest upgrade from the long-held forecast of US 75 cents. What keeps us at razor's edge is that volatility in asset markets around the world is unusually very low. At some point, volatility will break out. It will be interesting to keep an eye on volatility developments.